Good afternoon, everybody, and welcome to this edition of our weekly Think Tank for Monday, December 21. Will Santa Claus deliver us the old Santa Claus rally this week as we head into Christmas? Unfortunately, I don't think so, and we'll discuss that and more after we talk about the Think Markets difference, which is substantial $8 flat rate share trades, your own holder identification number, and unlimited phone support when you couple this with no hidden platform fees or subscriptions. It certainly is Australia's best offering for ASX share trades, and 10 more reasons to switch to us. Before the end of the year, 10 free trades, so get onto the website, download the Think Trader app and get trading. The agenda for today's Think Tank, well, it's a bit of a wrap of what happened last week, a little bit of a look to what's going to happen this week as well, and we'll go through all of those items. But first, the market moves from last week on the ASX 200 were pretty good for the first 4 trading days of the week. But as news of this new COVID cluster in Sydney hit markets on Friday, we saw quite a sharp pullback over 1%, but the weekly gain still 0.5%. Travel stocks got hit really hard on Friday, as you would expect. But overall for the week, the consumer discretionary sector did do pretty well on the back of a big move up in Afterpay. It went from about $100 to $120 in the week. Financials pretty flat, energy pulling back a little bit, gold up as the gold and silver prices rallied, information technology also being supported by that Afterpay push higher. Their material stocks still doing well as commodity prices were up. We'll see that in a second. Otherwise, telecoms also not too bad, and the rest a little bit of a muchness. Having a look at the chart for the ASX 200, we can see we were going pretty well into that Friday pullback. The problem I do see for the technicals here, I'll get the pen going. These peaks and troughs are getting, or at least the peaks are getting closer together. Okay, so we've still got some nice distance between each of these troughs as they're coming in. There's one little one there, and then there's one there. So yes, they're getting smaller, but there's at least still some distance between them. The problem is that the peaks are starting to get closer together, which indicates that we've got sort of, well, look, increasing supply up here. Yes, we've got demand is decreasing slightly because these are getting closer together, but still fairly robust demand, but that increasing supply is compressing prices into a tight trading range. Where to from here? Well, I still like to think after we might have a little bit of a pullback here on this COVID news, we'll be supported in this sort of 65, 6,600 zone, and then can move higher to test those all-time highs. It might not be this month, it might be early next month before that occurs. I'd be watching 65.11, 64.71 very closely. If we get beneath here, then we are in trouble, okay? And it would be time, I think, to take some risk off the table. Until then, I think hold fast and continue to look for quality stocks to buy in pullbacks, anticipating that move higher. Having a look at the rest of the world, US stocks, particularly the NASDAQ technology stocks, were higher. That was powered by a big rise in Tesla, which is being added to the S&500 Index this evening. And the reason for that big rise in Tesla is that when it becomes part of that index, there are a number of fund managers out there that have no choice but to purchase the stock, and that's why we've seen it going up in anticipation. Some of them are able to buy in advance. You've also got active fund managers. They can buy anytime they like, expecting passive fund managers to fall over themselves to buy the stock. They're buying advance as well, and we're going to see, I guess, the culmination of all of that tonight when it opens trading for the first time as a constituent in the S&P 500. It's going to be about 1.5 to 1.6% of the index. It's going to be about the 6th biggest stock on the index. They've never added a stock this big before, so it'll be interesting to see how that goes. I think if there is a problem with it going in, it's it's obviously a more volatile stock than the S&P 500, and because of its size, it's going to make the index more volatile by default. So that's one issue potentially for us back here. We do tend to follow the movements in US markets. So if US markets become more volatile, then potentially our markets also become more volatile. I think the other issue is that with Tesla coming in after such a huge tear in its share price, I mean, it's up over 60% in just over a month since the announcement was made it'd be joining the index. It's up almost 700% this calendar year. If it does experience a period of weakness, and on average, stocks that are added to the index after their addition tend to be flat at the very best, and sometimes they do pull back. That's going to weigh on the index as well. So very interesting times for Tesla. Good to see the volatility index coming down. I think that's helpful for markets overall, given some of the potential volatility factors that are still out there. So that's a positive, and it was good to see the DAX in Europe also up 4%, Shanghai up 1%, otherwise it was pretty quiet. Now this was very impressive, the moves in base metals prices, both on the London Metals Exchange, that's the LME there, and a couple in the US on high-grade copper up 3%, and in China iron ore was also higher, but strong gains across the board, and we saw gold and silver particularly tick higher there. As the US dollar weakened, we can see this, we're expecting another stimulus package, obviously significant impacts from COVID as well, so weaker growth, more printing of money, typically going to be quite bearish for the US dollar. That helped the Australian dollar climb to over 76 cents US. It's pulled back slightly now, just trading under that mark, but we can see a number of other currencies also doing well. A little bit of concern is the rise in bond yields. They're creeping close to that 1% mark. We don't want to see them get over there, because I do think that will concern stock investors. Otherwise, good moves up for energy as well for the week. Okay, how are we tracking this crisis compared to the last crisis? Pretty similar, isn't it? And I guess if we are going to keep doing that, there's still a fair bit of upside before we get any sort of a pullback. So let's hope we keep moving in the right direction there. Not moving in the right direction, unfortunately, is the COVID case count situation in the US. We're still over 200,000 cases per day, as we are in Europe. A lot of these other curves, you can press pause and have a look, are starting to creep back up again. That's disturbing. We are in a northern hemisphere winter at the moment. China is flattening out, but Australia, we know the news. We've been listening to it with bated breaths, ticking up, unfortunately. So markets will start to factor in the possibility of a potential New South Wales lockdown, potentially similar to the one we had in Victoria. It won't be good for Australian economic growth. It won't be good for just sentiment in general. And even if we don't get that, I think sentiment has taken a little hit, because in Australia here we were getting a little complacent with the COVID situation. We were enjoying the great recovery we had, and this tells us now that even if we get on top of this one, you never know when the next hit is going to occur. So I think we could see, as I said in the introduction, Santa Claus might not be visiting this year, and I think that's a big part of it. What could rescue us, of course, is a big pop on Tesla that helps the S&P 500 up, or we get this new US fiscal stimulus package, which is potentially due out as early as this evening as well. So US lawmakers on Friday voted for a 2-day extension. That's after giving themselves an extension prior to that. So they're temporarily funding the US government, and if we do get what we think we're going to get, which is close to $1 billion US of stimulus, then that could also counter this effect of the COVID situation. Having a look at some of the data out during the week, and it was gangbusters for the jobs creation number there, 90,000, well above the 50,000 expected. Yes, it's a little bit lower than the previous months, but still heading quite concertedly in the correct direction, as is the unemployment rate coming down, and importantly the participation rate is going up. So watch that participation rate. As long as Australians feel confident of their ability to get a job, and that's what that represents, then we should see continued strong employment growth. Having a look at some of the data out of China, and China's a big reason why we're doing so well. We're seeing a continued uptrend in fixed asset investment. We're seeing industrial production hang around those pre-COVID levels. We're seeing retail sales continue their rise back to hopefully pre-COVID levels in the not too distant future, and the unemployment rate continues to fall. So good signs there for our largest trading partner, even though they don't like us very much at the moment. We saw good numbers for Australia, we saw good numbers for China. We're seeing a continued deterioration in the US economy. That is industrial production on the left, the Philadelphia Manufacturing Index on the right. A surprise, I think it was a surprise number, certainly for the Conference Board leading indicators, that one actually continuing its rise, but you can see retail sales dipping into the negative territory. Having a look at the housing index, which has been one of the clear pockets of strength for the US economy. Yes, some good data here, but the sentiment indicator, which is a little bit more forward-looking, ticking down there, albeit from record highs. The trend in weekly unemployment claims continues to rise. The Fed said that they would keep rates on hold, but they're obviously looking at all of their options. And I was travelling, unfortunately, last week. Well, not unfortunately. I got to go to Sydney, hand over a great big cheque for our Strawman Classic sponsorship that we did there for that program on Ausbiz, and of course meet all of the crew in Melbourne. That was fantastic at Think Markets. But unfortunately I didn't get to do this Broker Moves review, so this is a little bit of a clip from what would have been that review. Upgrades these are for last week, of course, and you can see a few there, no major trends I think in those. JB Hi-Fi going from neutral to outperform as Credit Suisse starts to have a better view of the retail sector in general. Seven West Media going from neutral to buy, and a big price target increase there, 185% on that price target from just 14 cents to 40 cents. Still about 23% upside seen in that one. ANZ went from underperform to hold. Having a look at some of the downgrades, and worth noting there are a few more downgrades this week than last week. We talked about ANZ. Well, it copped a couple of downgrades there from Jefferies and Value Engine from hold to underperform and hold to sell respectively. Price target decrease also at Jefferies. Other than that, National Australia Bank in that banking sector also got downgraded. Altium, big tech stock, often quite widely followed, got two down. Well, it looks like the same downgrade. One is just updating the previous one from buy to hold from Jefferies. They did increase their price target, however, and Zip, one of the most followed stocks on the market, isn't it, after Afterpay? That went from outperform to sector perform, and a 40% reduction in its price target from RBC Capital Markets. Have a look at some of the price target increases. Eagers Automotive, they had a trading update out last week, and it was well received by the brokers. 3 out of 3 price target increases there of around about sort of 6 to 15%, and still some upside seen there from Morgan Stanley, about 22% upside. Bapcor in a similar sector to Eagers Automotive, the auto parts sector. A very good trading update from them. Continued strong sales growth. The brokers came out, upgraded a lot of earnings estimates and their price targets as well. Still some upside seen there. BHP, it's in this upgrade cycle at the moment. JP Morgan increasing their price target by 8%. Now don't forget that, I know it says a dollar sign there, but that is in Great British Pounds. We'd like to get any broker insights we can, so we do cover those as well. Yeah, you can have a look through the list if you like there. Viva Energy had a trading update as well, and they got a few price target increases. Oil Search got one. Rio Tinto and Zip, well, we saw it previously, got downgraded, but there's a small price target increase from Macquarie. Okay, have a look at the price target decreases. So suffering this week, Newcrest Mining got a couple by about 10% each. Still some upside seen by both of those brokers. St Barbara as well, 25% reduction in their share price targets from Citigroup and Credit Suisse. But again, still some upside. That's a little bit of a theme here. While some of these price targets have come down, many of these brokers still seeing upside from the current price to their price targets. Okay, have a look at where the value is in the Australian market. We can see the PE has actually come down a touch from last week, so we're starting to see some of the brokers come through and on many of these trading updates increase their earnings forecasts for FY21, and that's brought our price to earnings ratio down. It's also increased our spread to the rest of the world. We're now looking like better value compared to the rest of the world, but I would say in both cases a PE of around 20 is uncomfortably high. What is a good PE is still the materials sector at 13.2, not so bad for the next one, which is financials at 16.4. Property, if you squint, it's okay at 18.3. I guess everything's relative. Other than that, you're starting to look a little bit expensive. And technology still at about 60 there for their 1 year forward PE. Let's have a look at some of the technical factors now. So we're checking here on how the stocks in the ASX 300 are trading against their moving averages. Now, moving averages from 5 periods, which is about 1 week, all the way out to 252 periods, which is about 1 year. And this is the percentage of stocks trading over those respective moving averages. So we are on the orange line here. So about 50% trading above their 1 week average. And then as you get out to sort of looking at 3 months here, you're up to over sort of 70% trading above that average all the way out to a year is pretty good. Where are we in relation to the pre-COVID high, which is this one here? Well, we're above that for most of the curve. That's pretty positive. Yes, we've come down a little bit over the last month, but we did manage to pop up a little bit from last week. So overall, I think that's pretty constructive. Have a look at the week ahead. Pretty quiet week, all things considered, heading into Christmas. We will have a shortened trading period on Thursday, that's Christmas Eve, and then we'll obviously have the day off on Friday and Monday as well, and we'll be returning for usual transmission on Tuesday after Christmas. Some of the data, well, we've got Australian retail sales. Now, that's the final number. We've already seen the preliminary on that one. That's coming out on Tuesday. The final GDP, also ancient history by the time we get it on Wednesday, so the market's not too concerned about that. What we will be looking at is the durable goods orders. That is a very important piece of data. A durable good is something large and expensive that you typically expect to last over 3 years. So before you go and buy it, you need to be pretty confident in your ability to be able to finance that. And all sorts of people and businesses and government organisations buy durable goods, anything from a fridge to a big piece of machinery for your business, or a tank if you're the US military. So it covers all parts of the US economy. So we will be watching that one very closely. And then the Federal Reserve likes this bit of information here, that is personal income and personal spending. And we've also got weekly unemployment claims. Okay, well, that's it for me for the year, I think. And just because of the fact that in terms of the think tank, Monday's a break next week, and then I think the next one won't be into the new year. So it's been certainly a pleasure delivering this particular series to you this year, and I look forward to joining you again in 2021, where we'll also be picking up on our Think Learning series as well, with the first one kicking off their Introduction to Technical Analysis, and the week after Ask the Experts, where you get to tune in and ask me anything about your portfolio. Don't forget, you do need to register for those events, so head to the website and certainly do that. Otherwise, follow the rest of our updates in the market news section, or you can follow me if you like on the Twitter handle there, or the Think Markets handle also. The disclaimer before I leave you is very important. It says everything we've discussed in this presentation is general in nature. Please be mindful of this before you apply any of it for your own investing, or if you like, certainly give us a call or check the website for further details. Don't forget, we are a regulated Australian broker, and some of our products could see you lose more than your deposits. It's been a pleasure joining you today. All the best for your trading and your Christmas and New Year. If I don't see you between now and then, bye-bye for now.